A new IPO, so it'll be HDB Financial Services.
And it's been one that's been awaited for a long time. It's going to be the largest issue, perhaps, at least as far as this year is concerned. We haven't seen something as big. We're talking about 12,500 crores. The subscription is open today. The price band is between 700 to 740 rupees a piece. The proceeds of this issue will be utilized for future capital requirements. About 2,500 crores comes into the company, and then there is a OFS part of it as well. So let's understand HDB Financial Services better. We have with us G Ramesh, Managing Director and CEO, as well as Jaykumar Shah, Chief Financial Officer at HDB Financial Services. Gentlemen, good morning and thank you so much for joining us. Welcome to the studios. This promises to be the start of perhaps many interactions in your due course of your listed independent financial market journey. So very interesting business, sirs, and I just want to put some context out there. A lot of your lending is happening in tier 3, tier 4 parts of the country. And for the benefit of our viewers, I just want to put this out there. We'll put some graphics as well, that the 3 key business verticals for HDB would be enterprise lending, which is almost 40% of their business. There's asset finance, which is another big piece. And then there is consumer finance. So just broad thoughts over there. You've managed to grow the AUM, if we go by past years, CAGR at roughly 20%. As you come to the market, what's the sense on the scale and size of the business, the growth, and the key drivers ahead for HDB? So,
thank you for inviting us today, and good morning to all the viewers. So we started the company in 2007, started lending in 2008. Today we have a balance sheet size of about 1,07,000 crores. It's an organically built balance sheet. We didn't do any acquisitions over the years. We have 19.2 million customers as we speak, presence in 1170 cities through 1771 branches. So that's the scale of our distribution. That's the scale of our business. And we've been growing through the last 17 years of our journey. What we believe is that India is a huge opportunity for our business. And just to clarify to our viewers that we are a subsidiary of HDFC Bank, but we do not get any business from HDFC Bank. We are independently an entity. We don't get leads from HDFC Bank or any of the group companies. And that's been since inception. We run our own origination, our own risk management, our own collections, our own technology stack. So our business and technology stack is independent of the bank. And we believe that, with a product suite that serves the needs of aspirational India, we are well poised for making the opportunities in the future.
Mr. Ramesh, I'm glad you're clarifying that point, that from a lending perspective, you're very different from the bank.
That's right.
But just clarify on this part, you do get, you do some services for HDFC Bank, right? The sale of services, as that part of it is called.
That's right.
I think FY24, it came down a little bit, the contribution from that segment, FY23 also. So just tell us what the thought is, because it's been giving you more than 1,000 crores of revenue every year.
Right.
So going forward, will that continue to be a big revenue stream? Are you looking to scale it down? What's the thought? The BPO part of the business for the bank.
Right. So we provide some BPO services to HDFC Bank and only to HDFC Bank. It's in the nature of collection services and some back office work that we do for the bank. That scale of that business really depends on the volume requirement of the bank. In the last few years, the bank has invested in digital capabilities, so some of the requirements have come down. While it's a significant part of our revenue, it's a very small part of our net revenues, which is a profit after tax. Given that our loan book itself is now 1,07,000 crores and generates significant revenues, it's a small portion of our net revenues in that sense. So not very material from a business perspective.
But it'll come down. That source of revenue eventually will be coming down.
Yes, relative to the lending business will come down, yes.
Let me just complete that point. Good morning, both of you. Thanks for coming down. So there are these RBI draft rules, right?
That's right.
With regards to overlapping business. How, as they are firmed up, what do you think is going to happen? I mean, what are the possibilities? How will you have to deal with it?
So essentially, the draft rules came out about 8 months back, right? Yeah. And the draft rules are really a document that's put out for discussion, which enables the industry to give its feedback. And the feedback has gone back to the regulator, and they're looking at the feedback. And as per the annual report, they're looking at the feedback. As I said, for us, the business is independent of the bank, right? And so very difficult to look at what might be the final circular at this point of time. I'll be back in your studio when the final.
Is it possible you may have to get rid of the business or merge it?
So those are scenarios we'll look at based on what the final circular says. As I said, we are run as an independent business. We don't see any, and the reason why we set up this business, independent business, is because we chase a set of customers which are fairly distinct from what the bank does, right? Or from what retail commercial banks in India do. For example, we have 19 million customers and 1,07,000 crore balance sheet, which means that our average ticket size is just about 1,65,000. We only do retail lending. Our top 20 customers account for less than 0.34%.
No, you're it's very, very granular.
Right? So that's the level of granularity of a business, and which is what I think is best service to an NBFC model.
Yeah,
that's
absolutely. And we'll talk about growth, and we'll talk about the real stuff in just a bit. I just wanted to get this point about HDFC Bank out of the way. It may also lead to HDFC, the bank, having to sell their stake down to 20%. So if that were to happen and it's no longer the parent, I mean, then does it affect...
So it doesn't affect the business model of the company in any way?
Ratings, ability to access
so
funds
I mean, again, it depends on scenarios of what happens, where does the ownership get transferred to, and things like that. So I said, you invited me to your studios again. We'll talk about it in the final circle.
I think you want to chip in as well.
As Ramesh quoted, RBI in its annual report has said that they will issue based on the feedback received. And I think that's an important point to know, that the regulator has taken in the feedback and it will work with us. Today, RBI is probably one of the finest regulators in the world, right? They've classified us as an upper layer NBFC, and as part of that, wanted us to list. So we'll work with our regulator to make sure, what's best for the company, what's best for the country. We'll go ahead from there.
Okay, all right. You all can't give us fixed numbers, but I just wanted to know about the way things are going to move ahead. The cost to income ratio is relatively high if you look at some of your peers. So how do you see that panning out in the time to come? And in the past year, maybe a couple of one-offs, but the credit cost spiked up a little bit. How is asset quality looking, and what's the way ahead?
So let me take that one first. So if you look at how Ramesh explained a bit about how retail we are. Now, when you're touching every single part of the country, right, and your average ticket size is approximately 1,65,000 and you're disbursing 4,000-5,000 crores a month, you can imagine how many touch points you have. If you were to give out a 5,000 crore loan, it's very different to giving out a 50,000 rupee loan. You still have to do your KYC, you still have to make sure your customer is good, you still have to make sure, you've understood the credit of the customer. That kind of retail granularity, right, demands the kind of cost that it does. The most important focus for us is the return that we generate at the end of the day. I think the way you look at different models, and you all analyze probably more than I can imagine, each model works differently, and this is a product that we've developed in a manner that services the real Bharat and at the same time delivers the right return for our shareholders.
So on that point of asset quality and what your shareholders can expect going ahead, I think about 30% of the book is unsecured right now, 70% is secured assets. Are you planning to maintain a similar ratio? Just give us some more sense on the unsecured part, because typically that's better for business, higher yields. So what's the thought process between secured, unsecured, the way you see yields moving as the book grows?
So we have a 73% secured and 27% unsecured as on March 31st, 2025. That's been in the range of 75, 25, 70, 30 over the last few years. Unsecured lending is a business that we've been doing since 2008. That's the first business we started. As I said, our focus has been that how do we touch our customers' lives as many times as possible through our products. So our product development strategy has been around making sure that whenever a customer has a credit need, do we have a suitable product that meets the customer's requirements? So it's a business that we've been doing now for 15 plus years, very comfortable with a 75, 25, 70, 30 range.
Okay.
In terms of growth, I mean, it's a long, highway of growth, and most lending institutions, and you're well diversified, you've got the name, you've got the branding, you've been doing this for a long time. Could you give us some sense of how growth will look? Large numbers, since we can't be specific, let's go long. We can't talk short.
So let's look at a few fundamental things. Right?
As you said, you're about 1 lakh plus odd crore size.
Yeah. All organically built, yes.
Yeah. So say in the next 3 years, where will that number be? I'm talking about,
Right. Okay. So I can't give you a forward-looking guidance, but what I can tell you is aspirations.
You can't give me forward-looking, so maybe really forward-looking. That's my roundabout. But
so one is that you look at our distribution, 1170 cities. You can imagine what the 1170th city actually looks like, right, in India. 70% of branches in city number 101 and beyond.
Yeah.
Right? A phygital distribution model, and one of the things Jay was referring to when we said our cost to income appears slightly high, but that's also because we're looking at the customer and saying, what is the best option for this customer to engage with us? So we don't say you can only do digitally or you can do physically. We're saying choose the method that you want. You can do a purely physical or purely digital. We are comfortable with either. Our response times on processing applications are no different, whether a customer comes into the physical model or digital model. The fact that the back end is fully digital, 97% of applications have a digital footprint, right, in the form of processing. And one of the propositions we offer to our manufacturer partners, and we work with more than 100 of them between our consumer finance and our commercial vehicle and construction equipment business, is that irrespective of where you are in the country, our response time will be the same. So whether it's a metro like Mumbai or whether it's a small town somewhere in Assam, our response time is the same. Our customer growth has been about 29% in the last 3 years. Our AUM growth has been about 20% last year. And we continue to think about what new products we can add to the suite we already have. And that's the way we think of growth.
Just a quick last point. Again, I know you can't give very specific answers, but we need to understand an assessment on the borrowing mix, the yield, the margin profile that aspirationally you think you can sustain and maintain. I think first half it's been around 7.6%, Jaykumar. In the past, on a full year basis, you've maintained margins upwards, northwards of 8% as well. We're in a rate cut environment. So what's the sensitivity to margins in a downward rate regime? Just give us some color. Is 8% sustainable, long-term basis?
I'll give you two components to it. One is our yields and second is the borrowing cost.
Yeah.
And we have a very matched principle in terms of how we borrow. So we don't borrow short and lend long. We don't borrow too long and lend short, either ways. So we have a 3.5-year book approximately, and we borrow 3.5 years. Now, on that, one important component is, if you look at rates that were there in 2021-22, it had gone down to as low as 5.7 and 6. And the rates that came out in 2024-25 were approximately 8%. So one of the things which happened is a spike of around 200 bips, which just shot up very fast. Now, for a retail business like ours, when you're going to a customer, neither does it go up very fast, nor does it go down very fast. So that's a bit of spike which has come through. As the balance comes back, I think things will fall in place.
Which means higher margins eventually as we go down the cycle.
So the way I would look at it is, what was I borrowing at maybe in January to now? The rates have purely cooled off by almost 50 bips. That's just a statement in the market. And with our parentage, with how we operate as a company today, we are probably the finest borrowers in the market. And that's just public data. 37% of our loans come from bank borrowings, and more than 45% almost comes from NCDs. We're the largest issuers of debt today in the 2 to 3 year space in the country. Okay. So we don't talk about it as much, but we're very happy that, we can work behind the scenes. Our treasury is completely independent of the bank. We operate on our own and make sure we fund our own assets.
Are your most of your loans, are they fully linked, external benchmark linked? How frequent is the reset? I'm just trying to understand how quickly you have to revise them lower.
So in terms of our loan book, only our LAP book, which is around 23% of our overall book, is floating. Okay. The remaining entire 75-76% is completely fixed rate.
All right. We'll talk numbers and guidance next time you're on, and after that as well. Thank you both for joining us.
Thank you. And
thank you so much. Pleasure.
Good luck.
And during that conversation, we already fixed the next couple of interviews. So looking forward to having you back in the studio. Thanks a lot.
Thank you so much. Thank you for inviting us today. Thank you.